Morning students, this is SD Pawar, lecturer Department of Economics, Goktepu College of Commerce and Science, Belgaum. Today we shall do the ninth part, which is the concluding final part of national income. We will deal with the last question in this. Take the screenshot so that it is better for you to learn. Explain the macroeconomic identities for 6 marks. First one, there are 11 identities. First one is gross domestic product at market price. Firstly, now what is the meaning of gross domestic product? Domestic means what? Domestic means the goods, the GDP or the goods that are produced within the borders of the country by the people of the country. Okay, domestic means the production of goods and services taking place within the country only is called as a domestic product. We use the term gross because it includes depreciation charges. Now, GDP at market price is equals to C plus I plus G plus X minus M. This is the same formula for which we have used for expenditure method of calculating national income. So that is C stands for consumption expenditure of the household and firms, investment expenditure of private firms. G stands for government consumption and investment expenditure, plus X minus M stands for net exports of the country. Then second identity is net domestic product at market price. Net domestic product, the only difference between gross domestic product and net domestic product is what? Simply you can write NDP at MP is equals to GDP at market price minus depreciation. When you deduct depreciation from GDP at market price, you get NDP at market price. What is depreciation now? It is the allowance for wear and tear on capital. For production purpose, machinery is used, factory building is used, and there is repairs for it, there is maintenance for it due to constant use. So there is a wear and tear, and that is to be deducted. So it is net domestic product at market price. Third identity now, gross national product at market price. Okay, we have done gross domestic product at market price. Now let's see gross national product. The difference you should know firstly between domestic and national. Now we have seen domestic is what? The goods and services produced by the people of the country within the country itself, that is a domestic product. And when we use the term national product, it is, that is GDP at market price plus NFIA, that is net factor income earned from abroad in the form of rent, wages, interest and profits by the NRIs, non-resident Indians. Now you know certain Indians, they are staying abroad, they are working in different countries of the world, and when we calculate the national income of our country, we add the income that is earned by the NRIs, non-resident Indians staying abroad. So that is net factor income earned abroad. So GNP is what? The goods and services produced within the country plus income earned from NRIs, non-resident Indians, or you can write net factor income earned from abroad in the form of rent, wages, interest and profits. Then fourth identity is net national product at market price. Now again, gross national product is what? It includes the depreciation. Then from the gross national product, if we deduct the depreciation charges, then it gives us what? Net national product. So NNP at market price is equals to GNP at market price, gross national product at market price, minus the depreciation charges. I hope you are understanding it. I have done it in very simple form. Then let's come to the fifth identity, gross domestic product at factor cost. Now we have done GDP and gross national product at market prices. Now we will see at factor cost. Market price means what? It is the current year prices. It is the market price, which includes indirect taxes, and there is no subsidies are added in it. So we have to just do the So we have to do the necessary deduction and additions to it. Let's see. GDP at factor cost is equals to GDP at market price. We have to take GDP at market price. From that we need to deduct or minus the indirect taxes. What is indirect taxes? Indirect taxes is the GST now. Earlier it was sales tax, we used to call it as, then we called it as VAT. Now we call it as what? GST, that is the indirect tax. Goods and sales, goods and goods and service tax, that is indirect taxes. Now market price means what? It includes the indirect taxes in it, which will increase the value of the product. So indirect taxes are to be deducted from it, and these indirect taxes, they go to the government. Okay, then we have to add subsidies to it. That is, now these subsidies are given by the government to the producers, and so to that extent the cost of production of the producers becomes less and factor cost becomes less. But the subsidies are borne by the government, which is an expenditure to the government. So subsidies are to be added to get the real price of the factors of production. So factor cost, GDP at factor cost is equals to GDP at market price minus the indirect taxes plus subsidies. Then sixth identity, net domestic product at factor cost. From the net domestic product domestic product at market price, similarly again, when you deduct indirect taxes and you add the subsidies, you get net domestic product at factor cost. Then seventh one, gross national product at factor cost. Gross GNP at factor cost is equals to GNP at market price minus the indirect taxes plus the subsidies. Eighth one is net national product at factor cost, that is NNP at factor cost is equals to NDP at factor cost, net domestic product at factor cost, plus NFIA, that is net factor income from abroad earned by the non-resident Indians in the form of rent, wages, interest and profits. Then we come to the ninth identity, that is personal income. What is the personal income of a individual? That is PI, personal income, is equals to national income from the total national income minus the undistributed corporate profits. Now a company in which an employee earns, that company is earning certain profits which are not distributed to the employees, they are retained by the employer, that is they are undistributed corporate profits, minus the net interest payments made by households, that is whatever loan a person or a house may have taken after deducting all the interest payments, then minus the corporate tax. Now an employee works in an institution or a firm or a company, so a compulsory deduction, that is corporate tax, is deducted. Then to that transfer payments are added. What is the transfer payment? These are the transfer payments are made by the government and the firms to the household or to the employee. These are one-sided payments made by the government or the employer to the employee without any expectation from their side, from employee's side. Okay, like gratuity is there, then you can call them as a social security measures also. Okay, so after all the deductions, then personal income is obtained. Then next one is personal disposable income. See, personal income does not mean that he can immediately start, that the whole personal income is his. There is another concept or identity after personal income, that is personal disposable income. That is how the income can be disposed or how the income can be spent by an individual, the entire income that he can spend. Okay, so PDI, personal disposable income, is personal income PI minus the personal tax payments. Personal tax payment means the direct taxes, that is the income tax. He may have to pay income tax. Then minus non-tax payment. Non-tax payment means these are the payments that he may have to pay, like fines, duties, penalties. Okay, after paying the direct taxes, that is personal income tax, wealth tax, then and again he has to pay non-tax payments. These are payments made to the government, but they are not in the form of taxes. They are fines, dues, any penalties or fees paid to the government. Okay, after this, then he is free to spend his income in the manner he wants. That is called as personal disposable income. Then 11th identity is gross value added at market price. We have done this in the product method or value added method. It is what? Nothing. Gross value added at market price is equal to GDP at market price. Gross value added at market price is also known as what? Gross GDP at market price. Here we come to the end of this particular topic, national income. I have just written here a note for understanding purpose only. Indirect taxes are what? They are paid by the people to the government. Okay, so it should be deducted to get the actual factor cost of the production, and subsidies are given by the government for production purpose, so they should be added to get actual factor cost. And transfer payments are one-sided payments done by the government or the private employers to the employees without expecting anything in return. I hope you have understood this lesson. This lesson carries 20 marks from examination point of view. I hope you have understood it. Thank you for today.